Hi, it's Megan. So I had a great suggestions, and it was something I've been thinking about doing anyway, but just never got around to it. And I'm a little late getting it up, but someone suggested, one of my subscribers, that I do a video on investing. And I've mentioned in a couple videos that my background was actually in finance. And so my background, what was it? I was a stockbroker at Merrill Lynch when I got out of college. And I did that for a few years. So I went through the whole training program and I invested people's money. And then I went to law school. And then I became an investment banker, working with companies, primarily technology, internet, consumer retail, branded kind of products. And now I'm doing YouTube videos. But I do know a lot about investing in financial markets, both from the individual side and then also from the corporate side. And, you know, raising money, investing it, what to do. So this video is actually going to be the first of a series. And in this one, I'm just going to go through an overview of investing. And I'm going to link this particular video in the description of every video that follows, because this one's going to be the overview, and then delving into these individual topics are going to be separate videos. So this is where you start, and then the substance behind a lot of what I'm saying is going to be in different videos. And if there are things you have questions about or want information on or separate videos on, just let me know, and then I can do videos about them. I'm trying to keep it kind of structured and controllable and understandable. So to me, a lot of these terms are just obvious, but that's because I did it for so long. And it's important. I mean, people want to do what's best for their families long term, and investing is part of that. So the first thing to think about is asset allocation, which is how you're going to put your money. And there are basically three categories that count as like the three main categories of asset allocation. And how much you put in each bucket of these three is dependent on your age. And so the older you are, the less risk you're supposedly able to take. And then also your risk profile. So some people are going to want to take more risk, and some people are going to want to take less risk. When you're approaching, and I'll go into the three categories in a second, but when you're approaching investing, the really big questions to ask yourself up front are, you know, what is my objective? How much risk am I willing to take? When do I need this money, if I need this money? How much can I afford to invest? If you can afford to start investing a little tiny bit earlier on, then it's going to accumulate a lot faster than if you just try to invest in bigger lump sums later, which is compounded interest, which is the longer it's sitting there, the more it grows very quickly. And there's that whole rolling snowball kind of an analogy. And then also whether or not you want to actively manage your investments or whether you want someone else to do that for you. So asset allocation. What we're talking about here are basically three categories: stocks, bonds, which are fixed income assets, and then cash or cash equivalents. And historically, and I'm going to argue some of what is true historically. Historically, stocks are held to return 8% per year on average. That's really dependent on risk. The next are bonds, which are assumed to return 4.5%, which I think is a ridiculously high number given our very low interest rate environment right now, but we're going to stick with it for this second. And then inflation is supposed to be about 3%, and that's supposed to, fixed income and inflation are supposed to reflect what you get paid for your cash assets. But quite frankly, any kind of a cash holding equivalent thing like a CD or something, or a money market account, is paying under 1% too often. So 3% might be the inflation rate, although they're saying it's lower right now, but it's definitely not what you're going to get in your money funds at this point. Okay, so stocks. Stocks are essentially ownership in a company. That's it. And so if the company does well, you get to enjoy the benefit of that appreciation and the value of that company. If the company does really poorly and goes bankrupt, then you lose your investment. So stocks are a riskier investment than something like the latter two, the bonds or fixed income and the money market. But that's where you're going to get the best appreciation. There are also different types of stocks, and I'll discuss these in greater detail in later videos. But they're basically value stocks, which are supposed to be priced at a value, kind of like a sale value, compared to other companies in the industry or compared to the underlying value of the company. There are dividend companies, and so a company that's paying dividends, which is basically often twice a year, sometimes 4 times a year, money they're paying back to shareholders, is a company typically that has a stable, predictable cash flow, and they're also profitable. They can afford to give some of that money back to their shareholders. They don't need to invest that money in the business. A growth stock, on the other hand, is one that's in that kind of rapid growth stage of the company. A lot of times tech stocks are in this kind of phase, younger companies, and they need all that money to grow, and so they're retaining all that money. They're not giving any of it back to stockholders, and so they're called a growth stock. But you're going to get higher risk, theoretically, and higher appreciation. And then there are also sector-specific investment strategies, which is you want to do a lot of oil and gas, or you want to do a lot of consumer retail. You pick an area that you like, and you put more money in that area. There's also this balance between large cap, mid cap, small cap, and micro cap. So large cap stocks are the really big companies. The mid cap, and that's like the NASDAQ, or not the NASDAQ, that's like the Dow Industrials. Standard & Poor's is kind of often, historically, has been like the mid cap, the mid-sized companies. The NASDAQ used to be the smaller, small cap companies, but that's no longer the case. But these are kind of the younger, smaller, 100 million value, kind of maybe lower. And then the mid cap are just the really small companies. And theoretically, the smaller the company, the greater the potential risk, but also the greater potential ability to grow quickly. Because to grow 10% in a $10 billion company is much harder than to grow 10% at $100 million or even a $10 million company. It's just incrementally much bigger. Then there are bonds. So these are fixed income securities. And essentially what you're doing here is you're loaning someone, something, an entity, money. So they will be paying you interest payments, very often every quarter or twice a year, a set interest rate, and then at the end of that, technically a loan kind of thing, the bond, then they will pay you back your principal. And fixed income bonds are typically priced at $1,000 each. So they do fluctuate in value. If interest rates go higher, your bond face value, which is that $1,000, will drop in the market, but you will still get that $1,000 when that bond, that loan comes due. If interest rates drop, then your bond might rise in market value, but it's still only worth $1,000, just because money costs a certain amount. And as interest rates change, the value of your bond traded becomes more or less valuable because other investors can get bonds with a certain interest rate, and so that particular bond is going to change in value in the market so that people are getting essentially the same return on the older securities, the older bonds, as they are on the newer ones, but you still pay off at the face value of $1,000. There are also something called zero coupon bonds, which are sold at a discount, and then every year, theoretically, they are appreciating a certain amount based on the interest rate you're getting paid, and then they pay off at $1,000 when they get due. So in bonds, in the fixed income securities, we have investment grades, which are above a certain investment rating. They're less likely to default and not pay, or less likely to go bankrupt and pay nothing. And then there are junk bonds, which are kind of below investment grade, and theoretically they have to pay a lot more for that loan. So they're going to pay a little bit higher of an interest rate, but you're taking on more risk. Then there are government-related bonds, so that would be municipalities, which are typically state or local, or a specific project that is somehow government-related, and so you're going to be exempt from certain taxes. If it's a state bond, you're going to be exempt from state taxes on the appreciation or interest from those. If it's a city one, you're going to be exempt from local taxes. And then there are treasuries, which are American government bonds. These tend to have the lowest interest rates because theoretically our government doesn't default. So at least you know you're going to get that money back. But they also are going to pay a lower interest rate because of that safety and security. And then you're exempt from paying federal tax on those. Then there are foreign government bonds. So we've got corporate, American government entities, foreign bonds. We have investment grade, and then we have junk bonds or sub-investment grade. And then both for stocks and for bonds, you also have the option of buying other markets, so foreign markets, developed markets like Europe, emerging markets, which would be like Thailand or Turkey, a little bit more established. Then the last one, which are the frontier markets, and these are like the rough and tumble where the markets aren't that freely traded and you necessarily can't get out of those investments if you want to. You could lose all your money or you could really make a lot of money. And that would be countries like Egypt or other countries in Africa where they're just not as secure. And then the last category is cash and cash equivalents. So these would be deposit accounts, checking or savings, money market funds, CDs, and these are where you take the least risk most of the time. In the financial crisis, some money market funds defaulted, but for the most part, you're taking the least risk with these type of investments because your money is sitting there, it's liquid, it's easily accessible. If you need it, you can access it. And then there are alternative investments. These include things like commodities, which are precious metals, non-ferrous metals, agriculture, energy, commercial or residential real estate, also REITs, which are like a pool of real estate, collectibles, arts, coins and stamps, insurance products, annuities, life settlements, catastrophe bonds, personal life insurance products, etc., derivatives, long-term, short-term, options, and I'll get into that in another video, collateralized debt, futures, foreign currency, venture capital, private equity, distressed securities. And then I want to say one more thing, which is about mutual funds. So mutual funds are just a pool of something. It can be a mutual fund with lots of stock in it. It can be a mutual fund with lots of bonds in it. It can be commodities. It's just a pool of different things. And you're buying an ownership in that pool as opposed to an ownership in a specific company or a specific debtor's debt. And these can be either actively managed, where there's a manager trading, buying and selling based on a strategy, or they can be index funds, where they're just buying whole index, whether it be like the S&P or whether it be like all of Turkey, the Turkish market, I mean. So these are just, this is an overview. This is, if you're starting to think about investing, these are the types of investments that you can pick, but then, you know, start thinking about what your objective is, what kind of money you want to invest, how much you can afford to lose. And then in every video that comes after this, I'm going to delve into these specific topics in detail, but I would love to get feedback from people and hear, what do you want to know about? What questions do you have? And I'm going to try to incorporate a lot of those questions and the answers to those questions in the next set of videos. And then the other thing I'd love to hear is this a good idea? Do you want to know about this? I think it's really important that people plan for their financial future, and this is one way where I can help you do that. Anyway, thanks. Please subscribe on YouTube. And if you're not interested in this particular series, then, you know, just skip it. Anyway, that's it, and thanks for watching.